Tesla's stock value has grown impressively over the years. From a humble beginning to becoming a leading force in the electric vehicle industry, Tesla's growth story is nothing short of remarkable. Imagine this. If you had taken the plunge and invested $5,000 in Tesla back in 2018, you would be sitting on a little over $40,000 today. That's right, your initial investment would have multiplied eightfold in just 6 years. Tesla's journey from an ambitious startup to a global powerhouse in the automotive and renewable energy sectors is a testament to its innovative approach and relentless pursuit of excellence. The company's financial performance has been nothing short of stellar, with its revenues and profits growing at a steady pace year after year. From 2018 to 2024, Tesla's stock value has seen a phenomenal increase of 52% per annum. This impressive growth is not just a result of market speculation or investor exuberance, it's a reflection of Tesla's strong business fundamentals, innovative product lineup, and robust financial performance. Tesla's revenue growth over the years has been exceptional. In 2023 alone, Tesla generated a staggering $96.8 billion in revenue. This is no small feat, considering the company has been growing its revenue at an average rate of 35% per year since 2018. Let's break this down year by year. Between 2018 and 2019, Tesla saw a 14% increase in revenue. This growth accelerated the next year, with a 28% increase in revenue from 2019 to 2020. In 2021, the company's revenue shot up by an impressive 71%. The following year, 2022, still saw a healthy increase of 51%. By 2023, the growth rate had slowed somewhat to 19%. But considering the high base from which it was growing, this is still a significant achievement. Now it's important to understand where this revenue is coming from. A whopping 94% of Tesla's revenue comes from its automotive sector. The remaining 6% is generated from energy generation and storage. Geographically, the United States accounts for 47% of Tesla's revenue, while China and other regions contribute 22% and 31% respectively. Tesla's consistent revenue growth is a testament to its market dominance and increasing popularity. The company has been able to continually expand its customer base and sell more cars, which is driving its top-line growth. At the same time, Tesla's entry into the energy generation and storage market is providing another source of revenue, albeit a smaller one at this stage. In summary, Tesla's revenue story is one of consistent and impressive growth. The company has been able to leverage its brand, technology, and product offerings to generate increasing amounts of revenue year after year. This trend bodes well for Tesla's future, as revenue growth is a key driver of business success and shareholder value. A company's profit margins can say a lot about its business model and competitive landscape. As we delve deeper into Tesla's financials, we find that in 2023, the gross profit margin was 18%. This may seem impressive, but when we compare it to the 5-year average of 21%, we notice a slight decrease. Now, what does this tell us? It could suggest that the competitive landscape of the electric vehicle industry is intensifying, or perhaps market saturation is starting to set in. Both scenarios can put downward pressure on profit margins, as companies may need to lower prices or increase spending to maintain their market share. But let's not rush to conclusions. While a decreased gross profit margin could signal challenges, it's also essential to consider the net profit margin, which tells us how much of each dollar of revenue is actually translated into profit. In 2023, Tesla's net profit margin was 15%. Now, when we compare this figure to the 5-year average of 6%, we see a substantial increase. This is where things get interesting. Despite the decrease in the gross profit margin, the rise in the net profit margin indicates that Tesla has been strategically managing its costs. One might wonder, how is this possible? Well, it's quite simple. Tesla could be implementing efficient cost-cutting strategies, such as reducing research and development expenses or general and administrative costs. This strategic cost management allows Tesla to increase its net profit margin, even in the face of potentially increased competition or market saturation. In conclusion, while Tesla's gross profit margin may have experienced a slight decrease, the significant increase in its net profit margin shows that the company is not only surviving but thriving in a competitive market. It demonstrates Tesla's ability to strategically manage costs and convert a larger portion of its revenue into profit. Despite the competitive market, Tesla's profit margins and strategic cost management showcase its financial strength. A company's financial health is not just about profits, it's about how effectively it manages its assets and cash flow. Let's take a deep dive into Tesla's financial health in 2023. The total assets of Tesla in 2023 were an impressive $107 billion, a significant increase from the $82 billion in the previous year. Its net assets stood strong at $63 billion, up from $45 billion in 2022. Now let's take a look at some crucial financial health indicators. The current ratio, which measures a company's ability to pay off its short-term liabilities with its short-term assets, was 1.73 for Tesla in 2023, up from 1.53 in 2022. This indicates that Tesla had a good short-term financial strength. Similarly, the quick ratio, which is a more stringent measure of liquidity, as it excludes inventory from its calculation, was 1.25 in 2023, up from 1.05 in the previous year. This shows that even in a crunch situation, Tesla could comfortably meet its short-term liabilities. But what about cash flow? Cash flow is the lifeblood of any business. In 2023, Tesla's operating cash flow, the cash generated from its core business operations, was a robust $13.3 billion. This is an indication of Tesla's strong operational efficiency and profitability. Furthermore, Tesla's free cash flow, the cash left after subtracting capital expenditures from the operating cash flow, was a healthy $4.4 billion. This indicates that Tesla had enough cash to pursue opportunities that enhance shareholder value. So, what does all this mean? Well, Tesla's strong financial health and robust cash flow underline its financial resilience and investment potential. It indicates that Tesla is not only profitable, but also effective in managing its assets and cash, making it a potentially rewarding investment. Tesla's strong financial health and robust cash flow underline its financial resilience and investment potential. A deeper look into Tesla's financials using the DuPont analysis gives us more insight into its financial performance. The DuPont formula breaks down return on equity, or ROE, into three components: net profit margin, asset turnover, and equity multiplier, to provide a detailed understanding of a company's financial health. In 2023, Tesla's ROE was 24%. This is a measure of how effectively management is using a company's assets to create profits. It's calculated by dividing net income by shareholders' equity. The first component of the DuPont analysis, the net profit margin, was 15% for Tesla in 2023. This represents the company's profitability after all expenses, including taxes and interest, have been deducted from revenue. The second component, asset turnover, was 0.91. This signifies how effectively Tesla uses its assets to generate sales. A higher asset turnover ratio indicates superior management of assets. The last component of the DuPont analysis is the equity multiplier, which was 1.7. This ratio measures a company's financial leverage. A higher ratio suggests that a company has been financing its assets through debt rather than equity. In comparison, the figures for 2022 show that Tesla had an ROE of 28%, a net profit margin of 15%, an asset turnover of 0.99, and an equity multiplier of 1.84. These figures indicate that while Tesla's ROE and asset turnover have decreased slightly, its net profit margin remained stable, and the equity multiplier decreased, indicating lower financial risk. Tesla's financial analysis paints a picture of a robust, resilient, and high-potential company. Its impressive stock growth over the years is a testament to its strong business model and financial performance.